Hello. Today we shall talk about US Treasury bonds and their impact on the deficits in the US budget and on debt servicing. So, what exactly are Treasury bonds? That's the loan papers that the US government issues that corporations and countries and sovereign wealth funds can acquire and get in return a certain fixed rate of interest rate called yields. So you buy bonds at a certain price, and in return, you get a certain yield, and the yield varies over time. When the Fed intervenes, the yields change, and it has an impact on the price of the bond based on what is called a coupon that's issued when the bond is purchased. Be that as it may, as of March 2025, the United States had approximately $28.6 trillion of bonds, essentially US Treasury securities, outstanding. So the total outstanding amount of US securities, the treasuries that have been acquired by corporations, by individual retail investors, by mutual funds, by sovereign wealth funds, by other state banks in other countries. Its total is 28.6 trillion right now. So out of which Treasury bills are 21.3% or about $6 trillion. Treasury notes is about more than half, 51.2%, about 14.8, call it $15 trillion. Treasury bonds are about 17 or so, just about $5 trillion maybe. Other type of securities are 10.5% or up to around $3 trillion of debt that's been issued. Now, the question is who holds them? Like I said before, it's going to be mutual funds, individual investors, and so on. But the largest holders of these bonds are, for example, Japan with about $1 trillion of US in its holdings, and China is second with about 768. Let's call it a round figure of $800 billion of treasuries, and the UK is about third with close to 750 billion or so, another 800 billion, let's say. They are the big holders. Now, what happens if the bond that has a yield, for example, 10-year note, a 10-year US Treasury today yields about 4.3 or so. It could rise due to various factors in the market. It could fall, especially when the Fed does a rate cut, the yields fall. And sometimes the Fed increases the yields to clamp down on inflation when it expects inflation to occur. So the Fed manages the yields of the treasuries. And it not only impacts when they tweak the yields, it impacts who purchases and how much of those bonds, or who sells them, who dumps them, for example. So the 10-year treasury rate, which is about 4.3, goes to 5%, say, because Fed expects inflation to occur, or Fed feels the economy is too hot. Then existing US Treasury bonds that have already issued will have a lower interest rates, 4.3 today, will likely decrease in price if the Fed were to crank up the interest rates. This is because investors seeking the highest available return will gravitate towards the newly issued bonds around 5% that have a higher yield. So this will drive down the price of older bonds that they hold that have lower yields now. So if the countries sell the US Treasury holdings that they have today for political reasons, if they don't like the US, for example, or don't like the policies of the US, and they start dumping US Treasury holdings in their portfolio, if they start selling them, the most immediate impact is a potential interest rise, an increase in interest rates of these bonds, the US Treasuries. This is because sending a large number of bonds will drive down their price, which in turn pushes up the yields, which is in reverse order. And thus the interest rates become higher, the yields become higher. So your mortgages are becoming going to be higher, and your uh, credit card interest rates will also creep up. Your car payments would creep up, and so on. So now let's look at the broader impact of yields of treasuries and so on, and its role in the market. So our markets are heavily influenced by foreign capital flows. They flow into this US Treasury, for example. It can also flow into the equities, the stocks of the various industry corporations. So they're influenced by foreign capital flows. If China buys a lot of, sells a lot of stuff to the US and gets dollars in return, where are they going to put it? So they're likely to plug it back to the US markets, into equity markets, or what they've been doing very frequently for 20 years is buy the US Treasuries. So the money cycles back to the US, and that sort of feeds into the stock market and into the economy overall in the US, because the government is borrowing money, spending your money, and it's some idiot out there to buy it. And China is very happy to buy, has been happy to buy the debt of the US government. When the budget starts expanding, we spend more and more debt. We don't have the money to spend in the US. So we say, okay, we issue some treasuries, and somebody is going to buy it and fund our profligate, our spending spree. That's been going on for a long time now, so much so that our deficit, our overall debt burden is $36 trillion or so to speak. It's pretty high out there, and we have to pay interest rates regularly, 6 months, quarterly, annually, to the people holding our debt. So our allocation shifts by various foreign sovereign wealth funds who have our corporate equities and US debt, the treasuries. They kind of fine tune how much of each they want to own in a sovereign wealth fund. The Saudis, the Norwegians, and other countries, Singapore, they have sovereign wealth funds. They want to invest in the US. They'll say, I want so much equity, maybe, or so much based on the yields. They might buy more or less of the US Treasury issued bonds. So that allocation keeps changing. Sometimes just a small percentage in over a year or 2 years. That can make interest rates rise in the US. If, for example, China owns $800 billion of US Treasuries, and they decide, you know what, we got too much exposure, let's cut down and slowly start selling $200 billion for the treasuries, or half of the holding, $400 billion, slowly over time. They don't want to sell it at the same time to make the market crash. So they start selling over a certain period. But then somebody is buying that stuff. They notice, the market notices it, and because the market is getting flooded by those bonds, treasury being sold by China, for example. The more of them available in the market, the yields will have to rise, because the buyers will have to be enticed to take over those bonds and treasuries being sold. So the yields start rising when the sovereign wealth funds start tweaking their portfolio and reduce or increase their exposure to the US treasuries in their holdings. Now, gold might also be where most foreign funds turn to instead of putting money into US treasuries if they feel like they have way too much of the US treasuries, or they're not very sure if they want to hold any more going forward. So they'll turn to gold as an alternative other than just US equities. For example, the German bond market and the Japanese bond markets are very small. So one might say they have limited liquidity, and so will a country like Norway and China sort of reduce the exposure to the US Treasury bonds and move it into, say, German bond market or the Japanese bond market? Well, they might do a little bit of that, but those markets are not very liquid. They don't have enough amount for others to jump in and buy them as an alternative to the US. The size of the US Treasury market is huge. So you can't just say, I'm going to go from US to Germany and then hope you'll be able to buy them all. This isn't enough to go around in German bond market or the Japanese bond markets. Anyway, so for a long time, the Chinese have been putting their dollar profits that they earn by selling junk to the US and the rest of the world back in the US buying US bonds. It's interesting, isn't it? So 30% of US treasuries are owned by the foreign investors now. Central banks of other countries are also some of those investors. And of course, investment firms worldwide do the same. Now, because the foreign investors buy so much, and when they do buy, it pushes the yields down because there's demand for the US treasuries. And it makes mortgages and car loans cheaper for us in the US when the buyers are there willing to take the US debt. These foreign purchases of the US bonds help us as consumers in the USA. Now, these foreign bondholders will not dump their bonds, the holdings, right away. Whatever they hold, that would make the bond market crash and ruin the investments too. So it'll be slow drip, drip, drip as they move the funds out slowly from the US bond to Treasury market if they so plan to do that. So, for example, we've been hearing news in the stock market news, a certain amount of buzz to say the Chinese have been selling US bonds as a whole. Well, they're not stupid enough to dump them all at the same time and crash the market. They own the US equities, they own the US tons of US debt. So if they want to lighten the load, they might do it by drip slowly. Now, so the foreign bond holders usually don't dump them right away. Everyone in the US too would start selling them. If you notice, Chinese dumping the US bonds, or some of the countries, a big holder, dumping US bonds. Others in the country, even you and I, if we have any treasuries, would start selling them, and the yields would spike like crazy when we all start to dump the bonds we hold. So most central bank treasury holdings are short term. They don't. If you can't predict how stable the US government is going to be, economy is going to be, or when they'll need the money back, you would tend to buy short term bonds, or what the T-bills as they're called. Typically, a 5-year maturity would be what most sovereign wealth funds and investment funds might go after. Quite a few may go for a 2-year bond. You and I might see a 5.5 yield on a 3-month US T-bills, and then we might go for it because it's a good short-term investment, and you get 5% for say that's a tremendous yield for a 3-month investment. The risk premium on the term is very low. The time period is short, and you get 5% for it, which is not bad. And so what happens now is that the central banks, quite a few own this 5 years, 2 years, and so on. Now, the Trump administration has been talking about converting this small 2-year, 1-year, 5-year bonds, treasuries, and sort of make them say, hey, when they start to mature, the Trump administration is planning on extending the duration of those bonds, converting a 2 year into a 10 year, for example. Now, which investor, which sovereign wealth fund would like the money tied up for 10 years? And they might object to it, but if you automatically decide, hey, what used to be your 2 year is now really a 10 year, you're only going to get your money back in 10 years. Or be happy collecting the interest in the meanwhile. Oh, by the way, don't worry about the interest rates that might rise. So that is kind of strange suggestion by the Trump administration, strange notion that they can extend the maturity duration. People would rather have the bonds mature, the treasuries mature, and then they have the ability to decide on the next how they can reinvest that. Rather than have some government decide for you and say your 2 year is not really a 10 year bond. I mean, I'm not sure they may be happy customers. And so what happens now if you start talking about doing this such kind of funny business? The foreign investors might buy gold or some of the bonds of some of the Western country, Australia, for example, if they come to fear that the Trump administration is going to extend the maturity term, that will sort of restrict their reinvestment abilities going forward. So now foreign investors are selling dollars and will buy gold and Bitcoin and so on, or other foreign currencies now, if what the Trump administration is planning to do is going to come about. So anyway, if the ratings of the US Treasuries are lowered due to all the tariff news or possible inflation expectations, or a certain loss of confidence in the US Treasuries, or the loss of confidence in the Fed, then all of a sudden the turmoil in the bond market is going to continue, become a noise level that the administration won't be able to ignore for a long time. So, well, that's an overview of the US Treasuries market, and its impact on the debt servicing must be clear. The yields, if it were to go very high, then the amount of money the US government would spend on servicing this debt would rise, cutting into a big budget, take a big chunk of the budget that would get diverted towards servicing the debt that were built up over time. The debt servicing is going to be crushing us in the future if it starts growing instead of getting shrinking down to a more manageable level. So just watch what happens in the bond market. The stock market's watching regularly. People in the know are paying attention to the fluctuations of yields and praying it won't go high. 10 year won't hit a 5 again. So anyway, it's interesting times.